Do you want to invest like a billionaire but don't know where to start? Warren Buffett, the Oracle of Omaha, cracked the code decades ago with 3 simple rules. But here's the kicker. They're not what most beginners think. Stick around and you'll see how these rules can make your investments bulletproof in 2025 and beyond. Part 1. The Journey to Simplicity. Warren Buffett's investing journey started long before he became the Oracle of Omaha. At just 11 years old, he made his first stock purchase, 3 shares of Citi's Service Preferred for $38 each. Like many beginners, young Buffett tried to outsmart the market with strategies like timing and chart reading. But instead of making millions, he learned a hard truth. Chasing trends and complex formulas leads to nowhere. Sound familiar? Most new investors fall into this same trap, thinking there's a secret formula to beating the market. But what if I told you the key to Buffett's success wasn't a formula? It was something far simpler. Instead of giving up, Buffett turned to the greats, people like Benjamin Graham and Philip Fisher, who taught him that investing isn't a game of speed or complexity. It's about understanding businesses and finding their true value. With this knowledge, Buffett stopped chasing charts and started looking at what really matters, the quality of the companies behind the stocks. Here's the first key takeaway. The stock market isn't just numbers on a screen. It's a marketplace of businesses. Buffett realized that focusing on the long-term value of these businesses was the only way to win. And this revelation laid the foundation for his 3 simple rules of investing. Part 2. Rule #1. Ignore the noise. The stock market drops 5% in one day. Headlines scream disaster. Investors panic and sell. But here's the truth. This is just noise. Warren Buffett has seen it all, from crashes to bubbles, and he knows better than to fall for the hype. Why? Because he looks beyond the chaos. Unlike farmland or apartment buildings, which quietly generate value over time, stock prices fluctuate wildly. But does the value of the land or the apartments change just because the market says so? Of course not. Buffett says the same principle applies to stocks. They're not just numbers. They represent real businesses. Ask yourself this. Would you sell a farm you own just because someone said it's worth less today than it was yesterday? No? Then why do that with stocks? Buffett argues that most investors lose money because they react to short-term fluctuations instead of focusing on long-term value. Buffett's key insight is this. Stock prices are driven by emotion in the short term, but by value in the long term. The smart investor learns to tune out the daily noise and focus on the big picture. He famously said, "The market is there to serve you, not to instruct you." In other words, don't let the market's mood dictate your decisions. Think about it like this. If your favorite coffee shop had its price change every day, would you trust those numbers or the steady stream of customers lining up for their lattes? Buffett applies this same logic to investing. Focus on the business, not the daily price tag. Here's a challenge for you. Next time the market dips, ask yourself, has the business I invested in really changed, or am I just reacting to noise? Remember, the best investors stay calm while others panic. Part 3. Rule #2. Focus on quality businesses. Here's a question. If you could own a slice of any business in the world, what would it be? Would it be a struggling startup with no profits or a global giant that's in your home right now? Warren Buffett's second rule is simple. Invest in businesses you understand and believe in. Buffett doesn't invest in trends or hype. Instead, he looks for businesses with solid fundamentals, things like steady profits, strong leadership, and competitive advantages. He calls these moats because they protect the company from competitors. Take Coca-Cola, for example. It's not just a beverage. It's a brand that people recognize in almost every country. That's the kind of competitive advantage Buffett loves. Now, here's the trap. Many investors chase the hottest new trends, thinking they've found the next big thing. But Buffett avoids businesses he doesn't fully understand, because if you can't explain how a company makes money, how can you trust it with your investments? Imagine you're investing in your favorite local coffee shop. You know the owners, the menu, and the loyal customers who come every day. Now compare that to investing in a company you've barely heard of, with no idea how it operates. Which one feels safer? That's exactly how Buffett picks his investments. Buffett's checklist for quality businesses is simple: consistent growth, great leadership, a strong competitive position, and, most importantly, a fair price. He's not just buying stocks. He's buying pieces of businesses he believes in for the long haul. So, what's your pick? Think about a business you'd be proud to own for decades. Because, as Buffett says, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. Part 4. Rule #3. Play the long game. What's the biggest mistake new investors make? They want to get rich now. But Warren Buffett has a different strategy. Play the long game. He says, the stock market is a device for transferring money from the impatient to the patient. And history proves he's right. Buffett's secret weapon is patience. He knows that wealth isn't built overnight. It's built through the magic of compounding. The longer you stay invested in a great business, the more your money grows exponentially. Imagine this. You invest $1,000 in a great company. After a year, the market dips and you sell. But if you had held on to that investment for 20 years, that same $1,000 could turn into $10,000 or more. Buffett doesn't just hold stocks. He lets time do the heavy lifting. Here's the tough part. The market doesn't rise in a straight line. There will be crashes, corrections, and moments when you'll want to sell everything. But Buffett's advice? Stay calm. Great businesses recover, and the rewards go to those who wait. Let's look at Berkshire Hathaway. Since Buffett took over in 1965, the company has weathered recessions, oil crises, tech bubbles, and more. But for those who held their shares, the payoff has been extraordinary, delivering a return of over 3 million%. That's the power of playing the long game. Here's where most investors fail. They panic and sell when the market dips. Buffett does the opposite. He buys more, holding on to great businesses for decades, even when others doubt his decisions. He's mastered the patience test, and it's why he consistently wins. Here's a challenge. If you invested $10,000 in 1990 and held it for 30 years, it could have grown into hundreds of thousands. So ask yourself, can you wait? Or will impatience cost you? Buffett's golden rule? Only invest in businesses you'd be happy to hold forever. Why? Because great businesses grow stronger over time, rewarding patient investors with compounding returns. When you play the long game, you're not just investing in stocks. You're building financial freedom. Buffett knows this, and now you do too. So remember, ignore the noise, focus on quality businesses, and play the long game. These aren't just Buffett's rules. They're the keys to financial success in 2025 and beyond. Ready to start your journey? Thanks for watching. If you found this video helpful, make sure to like, share, and subscribe to USA Finance and Trends for more insights on investing, finance, and building wealth. Hit the bell icon so you never miss an update. See you in the next video.